Okay, let's unpack this. Today, we're taking a deep dive into something that, well, it quietly shapes how credit flows across India, and it impacts millions of lives. Priority sector lending, or PSL.
Exactly.
Think of it as the Reserve Bank of India's crucial policy tool. It makes sure a significant chunk of bank credit finds its way to vital sectors.
Sectors that might otherwise struggle, right? Like agriculture, small businesses.
Yeah, education, even affordable housing. At its heart, PSL is all about ensuring credit reaches where it's really needed most. Lifting up vulnerable communities and, well, supercharging growth in sectors critical to India's future.
And what's really making waves right now, the reason we're digging into this, is that the RBI just dropped fresh guidelines for PSL. They kick in on April 1st, 2025. And these aren't just minor tweaks, they're pretty substantial updates.
Yeah.
Designed to really fine-tune how banks channel money into these vital areas. It's not just a regulatory adjustment. These new guidelines, they really signify the RBI's shift towards a more agile, maybe demand-driven approach to financial inclusion. It feels like they're directly responding to real-time economic shifts and, importantly, market feedback.
So what does this all actually mean for you listening in? Well, we're going to break down what PSL is, how it works, what's fundamentally new in these 2025 guidelines, and how these changes, ripple out, how they affect everything from getting a home loan to, say, supporting renewable energy projects in remote villages. Our mission here is to cut through the jargon, get you truly well-informed, give you that shortcut to understanding this critical economic mechanism. So before we dive into the nuts and bolts of the new rules, let's maybe get a clear picture of what exactly counts as a priority sector. How does the RBI decide which parts of the economy get this special designation?
Right. So the RBI has categorized PSL into 8 main segments. It's designed for comprehensive coverage. You've got agriculture, then micro, small and medium enterprises, MSME, export credit, education, housing, renewable energy, social infrastructure. And then there's a broader others category that includes things like microfinance and startups.
Okay.
The very existence of these specific categories, it really reflects India's evolving developmental priorities, where the country sees its biggest growth opportunities and, crucially, its social needs.
What truly strikes me about PSL, though, is that this isn't some recent idea, is it?
Not at all.
How far back does this concept of, directing credit actually go in India's financial history? I'm genuinely curious about its roots.
No, it's got deep roots. It goes all the way back to 1966. Morarji Desai was advocating for more credit to agriculture and small industries back then.
Wow, 66.
Yeah. Then it was formalized in 72 based on an RBI report. Initially, commercial banks got a target, just a portion of their total lending. That later increased to 40%. That was based on recommendations from Dr. K.S. Krishnaswamy's committee.
Right.
And while, look, it might have started with some political motivations, perhaps, it quickly expanded. It started covering many previously neglected sectors. Even today, though, it retains that strong foundational focus on agriculture and MSMEs, really, 2 pillars of the Indian economy.
And it's this enduring commitment to specific sectors that leads us to the next big question.
Yeah.
How does the RBI translate that commitment into actual lending targets for the banks? Because it's not just a suggestion, is it? How does it differ depending on the type of bank involved?
No, definitely not just a suggestion. It's very structured. These targets, they're calculated as a percentage of the bank's total lending capacity. Primarily, it's adjusted net bank credit, or ANBC.
ABC, right.
Which is basically its loanable funds after some adjustments. Now, instead of drowning you in every single percentage point, let's focus on the big takeaways. For most major banks, we're talking domestic scheduled commercial banks and foreign banks with 20 or more branches, the core target. It remains 40% of their lending.
Okay, 40%.
But, and this is key, within that 40%, the RBI mandates specific chunks for critical areas. For instance, a substantial 18% is earmarked for agriculture. That's about ensuring food security. And then there are specific sub-targets within that 18% for smaller farmers.
Makes sense.
There's also a dedicated 7.5% for microenterprises and 12% for loans to what they call weaker sections of society. It's less about memorizing every number, really, and more about understanding how strategically these targets are broken down.
Right, the different pieces.
Exactly. Now, for foreign banks with fewer than 20 branches, it's still 40% total, but they get a bit more flexibility. Up to 32% can go towards exports, for instance. Then, on the other end of the spectrum, you have regional rural banks, RRBs, and small finance banks, SFBs. They have a much higher overall target, 75%.
Yeah.
Which reflects their specific mandates, right? serving rural and underserved areas.
A much heavier lift for them.
It is. And they also have tailored sub-targets for agriculture, microenterprises, and weaker sections, often higher percentages than the larger banks. And finally, primary urban cooperative banks, UCBs, they now have a 60% total PSL target. That's actually a change. The phase target towards 75% has been removed.
Okay, that's a really comprehensive framework.
Yeah.
So let's talk real numbers then. Beyond those big percentage targets, what are the actual loan amounts that could impact you? What's noteworthy, say, in the 2025 revisions for education or housing?
Absolutely. Let's get practical. The headline here, I think, is the significant jump in education loans. Now, up to 25 lakh for individuals. And that includes vocational courses, too. It's a clear acknowledgement of, well, rising educational costs.
Definitely needed.
For housing, it's about making homeownership more accessible. The limits are tailored to city size. So up to 50 lakh in major metros like Delhi or Mumbai, and 35 lakh in smaller cities.
Okay.
And in renewable energy, we're seeing substantial support. Up to 35 crore for larger projects, think solar farms, windmills, but also, and this is quite important, a very accessible 10 lakh limit for individual households looking to install solar panels, for example.
Right, that brings it home.
Exactly. These aren't just tiny increases. They feel designed to make a real, tangible difference in people's lives and push specific sectors forward. And just to give you a broader sense, in social infrastructure, that means things like building schools or providing clean water. Sanitation facilities loans up to 8 crore are prioritized. But specifically in India's smaller cities and towns, what the RBI calls Tier 2 to Tier 6 centers.
Right, outside the big metros.
Precisely. For healthcare facilities in those same areas, that limit goes up even higher, to 12 crore per borrower. For agriculture, look, while there's no upper limit for individual crop loans, which is crucial, other farm-related loans have seen big increases, like up to 90 lakh against warehouse receipts for stored produce.
Helps with cash flow.
Definitely. Or up to 10 crore for farmer-producer organizations, FPOs. And for MSMEs and startups that fit the MSME definition, banks can lend up to 50 crore under PSL. That's clear support for entrepreneurship. Many other categories have also seen proportionate increases. It signals the RBI's push for broader credit access across the board.
Okay. And beyond the general categories you mentioned, there's that specific focus on weaker sections within PSL, ensuring credit reaches the most vulnerable. And you hinted there's a significant new addition to this group. Who exactly falls into this category, and what's the notable change?
That's right. The revised definition of weaker sections, it now explicitly includes transgenders.
Huh?
Which is a very important step, I think, for financial inclusion and equity. Other key beneficiaries in this group include small and marginal farmers, artisans, village and cottage industries, those with credit needs up to 1 lakh. Also, beneficiaries of government-sponsored schemes, scheduled castes and scheduled tribes, persons with disabilities, and minority communities. It also covers distressed farmers and, interestingly, individuals indebted to non-institutional lenders, local money lenders up to 1 lakh for non-farmers to help them repay that debt, and individual women beneficiaries up to 2 lakh.
That idea of a credit compass directing funds is quite vivid. But with such targeted credit allocation, are there ever concerns about maybe distorting the market? Or does the RBI's framework manage those risks by trying to balance things out, encouraging credit flow to areas that traditionally get less?
That's a really fair question. And the RBI is aware of this potential for regional disparity. To mitigate it, they've actually introduced an incentive framework. This is effective from FY 2024-25 until FY 2026-27. Basically, banks get a bonus weight, a 125% weight, for any incremental PSL credit they give in districts with comparatively low PSL credit.
So where it's needed more.
Exactly. Places where the per capita PSL is less than 9,000. It's a clear nudge. Lend more here.
And the flip side.
Conversely, in districts that already have high PSL credit, where per capita PSL is over 42,000, there's a 90% weight. It's essentially a disincentive for pouring more credit into already well-served areas.
So discouraging overconcentration.
Precisely. All other districts just get the standard 100% weight. It's quite a clever mechanism, really, to try and guide credit more evenly across the map.
It sounds as the RBI is really getting creative to make sure these targets are met effectively. It's not just about direct lending anymore, is it?
No, definitely not.
What are some of these more innovative ways banks are fulfilling their PSL obligations these days?
You're right. The toolbox is definitely expanding. One key mechanism is lending by banks to NBFCs for on-lending.
Okay, what does that mean exactly?
It means banks can give credit to registered non-banking financial companies, NBFCs, including microfinance institutions, or MFIs, and that credit counts towards the bank's PSL targets if the NBFCs then lend that money out to the designated priority sectors.
Ah, so they're leveraging the NBFC's reach.
Exactly. It's a way for banks to use the wider reach and, frankly, the specialized knowledge of NBFCs, especially in maybe reaching smaller borrowers or more remote areas. For instance, an NBFC might get a loan from a bank specifically to give out small business loans or agricultural term loans, things like that.
Right.
Then there's the co-lending model, or CLM. This one's becoming quite popular. Here, banks partner directly with registered NBFCs or housing finance companies, HFCs, to jointly provide a loan to a borrower.
So they share the loan.
Yes. The NBFC typically has to keep a minimum 20% share of the loan on its books, kind of skin in the game. The bank then provides the rest, and the bank's portion can be claimed under its PSL target. It's a way to share both the lending opportunity and the associated risk.
Okay, that makes sense.
And perhaps one of the most innovative things is PSL certificates, or PSLCs.
PSLCs, right. I've heard of these.
They were actually recommended by the Raghuram Rajan Committee back in 2009, and the RBI introduced them around 2015-2016. Think of them like tradable credits. It's quite neat. A bank that does more than its required PSL lending it overachieves can issue these certificates. These certificates can then be bought by banks that couldn't meet their targets.
So wait, they're not selling the actual loan?
No, that's the crucial point. There's no transfer of risk or the actual loan assets. It's purely a mechanism to fulfill the regulatory obligation. It's an ingenious market-based solution that allows banks to achieve compliance more efficiently while still ensuring the overall system meets the priority lending goals.
That is clever.
Yeah, and there are different types: PSLC agriculture, PSLC microenterprises, and so on. They're traded on an RBI platform, and they expire at the end of the financial year, March 31st.
That's fascinating. So if I'm a bank doing really well in, say, agricultural lending, I can essentially sell my extra credit for that category to a bank that's struggling to meet its own agricultural target.
Precisely.
That's a smart market mechanism, completely separating the underlying loan from the compliance aspect. Okay, the natural next question then is, what are the teeth behind these targets? What actually happens if a bank doesn't meet its PSL commitments, if they don't lend enough or buy enough PSLCs?
Really, there have to be consequences. If a bank falls short of its PSL targets, the RBI has clear rules. They must deposit the amount of the shortfall into special funds. Things like the Rural Infrastructure Development Fund, that's RIDF, managed by NABARD, and other similar funds with the National Housing Bank, NHB, SDBI, and NQDRA Ltd.
So they have to park the money they failed to lend.
Essentially, yes. And banks do earn interest on these deposits, but, and this is the stick, it's deliberately set lower than market rates. The rate depends on how big the shortfall is. The bigger the shortfall, the lower the interest rate they earn. For example, bank rate minus 2% for a small shortfall, but it could be bank rate minus 4% for a shortfall of 10% or more.
So it hurts their profitability.
It does. And perhaps most crucially, consistent failure to achieve PSL targets can really negatively impact the RBI's view when that bank applies for regulatory approval.
Like opening new branches or other expansions?
Exactly. It sends a strong signal about their commitment, or lack thereof, to inclusive lending. It can hinder their growth plans.
Okay, that's a significant motivator. Now, speaking of revisions and changes, you mentioned one earlier, but there's a pretty significant update specifically for small finance banks, SFBs, right? Effective for the next financial year.
Yes, this is indeed a very significant change, specifically for small finance banks. It kicks in from financial year 2025-26. Their overall PSL target is actually going to be reduced from the current 75% down to 60% of their AMBC or CEOB.
Reduced from 75 to 60. That sounds like a big drop.
It is, but there's a crucial nuance here. Within that new 60% target, 40% must still be allocated to the specified core PSL subsectors.
Okay. So the core focus remains.
Exactly. They still need to meet those fundamental developmental goals: agriculture, microenterprises, weaker sections. Those core areas make up that 40%. But the remaining 20% of the target, that difference between 40 and 60, can now be deployed more flexibly.
flex a way out.
They can deploy it across any PSL subsector where the SFB feels it has a competitive advantage or sees strategic opportunities. Maybe they're particularly good at housing finance in their region or education loans.
So it gives them more strategic freedom.
Precisely. It allows SFBs to perhaps focus their lending a bit more strategically, improve their balance sheet management, maybe diversify their risk better. It aligns their operations more effectively with their unique strengths and the markets they serve. It's a move that really recognizes the evolving role and perhaps the growing maturity of these specialized banks.
Right? Adapting the rules as the banks themselves evolve.
It seems to be the idea.
So wrapping this up then, what does this all really mean? This whole deep dive into PSL, it really reveals how deeply and how dynamically the RBI is shaping India's financial landscape. It's constantly working to ensure credit reaches, the furthest corners and the most vulnerable sectors of the economy. The continuous revisions we've talked about, the intricate targets, sub-targets, the clever mechanisms like PSLCs and on-lending, it all points to a system that's constantly adapting, trying to foster inclusive growth. It feels like a blueprint for development that's always being refined.
Absolutely. And if we connect this to the bigger picture, maybe step back a little, it does raise an interesting question, doesn't it? How do such detailed, you could say top-down, policy instruments like PSL, how do they effectively balance with the organic, maybe bottom-up needs of diverse local economies across India?
Right. The policy versus the reality on the ground.
Yeah. And what might this ongoing evolution of PSL, the incentives, the flexibility, the new categories, what might that imply for the future of financial inclusion? Not just in India, but maybe in other rapidly developing and diverse economies facing similar challenges.
That's a great point. How do you make central policy truly effective at the grassroots level? Something to mull over as you think about how finance really does touch every part of our world. We hope this deep dive has given you a clearer, more informed view of this essential and constantly evolving aspect of the Indian financial system.